Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. Welcome to another episode of Supernatural Stocks, and let me just start off by saying that I love my tax-free savings account, or TFSA. Really, I do. I think any investment approach that prioritizes other equity exposure over maximizing your TFSA allocation each year just doesn't make a lot of sense to me. Once that basic slush fund has been set up in your life and money market type accounts are established, really, for me, the next up should be exchange traded fund or ETF exposure in a tax-free savings account. Obviously, personal circumstances will vary, and all of the usual disclaimers about speaking to a financial advisor are important here. But why on earth would you not take advantage of this tax gift from government? And the way I use my TFSA is that I have an account with a broker, and this lets me trade a large number of exchange-traded funds within the TFSA environment. In other words, I'm not locked into a savings account somewhere. By maximizing the allocation each year, I'll eventually end up with a sizable pool of money that will earn tax-free returns forever. The power of compounding is wonderful here. And what's more is you can do it for your kids as well if you have the financial means to do so, giving them a serious head start in life when they reach maturity. Now, as you already know, I take an active approach in my investment journey. For this reason, I love my TFSA even more. You see, I'm able to rotate the exposure in my TFSA across these different ETFs without leaking any taxes along the way. This is the unfair advantage that funds enjoy over individual investors, where fund managers can generally adjust their exposure without incurring taxes along the way. Although retail investors like you and I cannot take single stock exposure in a tax-free savings account, otherwise we would sit all day just trading in our TFSA, right? The ability to buy and sell ETFs without taxes is really powerful. And a case in point is my decision to take profit on my US technology exposure and redeploy the capital into a mix of local government bond and property sector exposure. I'll be working through that trade with you on this podcast. You heard me correctly, selling big tech. I am the world's biggest fan of Microsoft, and I certainly haven't ignored the Nvidia run. Apple, sure, who doesn't like Apple? Those three companies contribute roughly 60% of the OneInvest S&P 500 Infotech Index Feeder ETF. What a mouthful. My personal favorite way to play the big tech theme. If you chart the share code JSE ETF5IT, which is only slightly less of a mouthful, you'll find that this ETF has given a 1-year return of 46%. Over 5 years, 320%. Astonishing stuff. Naturally, the timing of your investment affects the return. Even in a perfect world where you fund your TFSA in full on the first day of the tax year, you are still deploying capital every 12 months into the market. Due to the various timing issues, and when I started with my TFSA in my life, I've achieved a return of roughly 100% on my exposure to this ETF. And remember, that is a tax-free return. Isn't that wonderful? But the bigger question is, why am I selling out of this fund that has done so well for me? Well, we may as well start with Nvidia, which is now so huge that it contributes nearly as much as Microsoft and Apple to that ETF. The three of them are now almost equally weighted inside it. I'm certainly not smart enough to figure out where the top is for Nvidia. From speaking to people in the technology industry, it seems like artificial intelligence, or AI, is an almost unstoppable force of investment. Now, that may be so, but a return of 197% in the past year at time of recording is good enough for me. At some point, the market is going to correct. Now, the biggest holding in this ETF is actually Microsoft, which is a share that I also hold directly outside of my TFSA. The share price is up nearly 35% in the past year, and it now trades on a price earnings or PE multiple of just under 40x. It recently went over 40x before correcting slightly, and that is quite a psychological level. This puts Microsoft on the highest price earnings multiple that we've seen in recent years, including during the pandemic. I believe quite strongly in multiple reversion strategies, and with a 3-year average price earnings multiple of 33x, Microsoft is sitting too far above the mean for my liking. I cannot sell my single stock exposure to Microsoft without incurring tax, but I can sell this ETF. The other primary exposure inside this ETF, as already mentioned, is Apple. Now, this is another stock that I also hold directly, and in fact, as a Berkshire Hathaway shareholder, I've got Apple through there as well. But on a price earnings multiple of 35 times, it's not cheap. And if we take out the impact of Apple's cash pile on their balance sheet, which is quite a big part of the Apple thesis really, we can look at their EV over EBITDA multiple. That's enterprise value to EBITDA. It strips out the effect of excess cash on the balance sheet. That multiple sits at 26.5 times. Although we did see a higher level in 2021, the 3-year average for this multiple is 20.7. Again, my mean reversion approach is ringing the alarm bells here. I feel overexposed to Apple right now, and so I felt I should trim the exposure in the most tax-efficient way possible. And as a final point to this thesis, the risk of rand strength is also significant. If the GNU euphoria continues and the US starts cutting rates, that's almost certainly good news for the local currency. Although I'm certainly more worried about the equity valuations than trying to predict where the rand might go, it is a factor. Would I buy back into this ETF? Well, of course I would. These are the best companies in the world, right? I would just feel a lot better buying them at more sensible multiples. And this brings me very neatly to the next point about this trade. What to do with the money. Now, in a tax-free savings account, allowing your cash to just sit there and do nothing is pretty awful, right? If you don't generate any returns, then the tax benefit doesn't mean much, does it? Luckily, there are other ETFs that I'm happy to increase my exposure to. This is a good time to note that I did not have 100% of my TFSA exposed to that Infotech feeder ETF. Look, I wish I had, obviously, because it's done so well, but hindsight is perfect. Diversification is really important. I already had exposure to the JSE property sector via a couple of ETFs that have different weightings of the various REITs and property funds on the JSE. The thesis here is that REIT distributions are usually taxable at your marginal income tax rate, which means you are paying a hefty amount of tax on that yield. In a TFSA, you are paying nothing. You've basically turned yourself into a miniature pension fund, banking the full yield with no tax leakage and reinvesting it wherever you choose. For bond ETFs, the interest payments are also taxable at your marginal tax rate. Yes, there's an annual exclusion for interest income, but there's no protection above that level, and many investors are above that level. This makes a tax-free savings account really powerful for earning these interest payments. The trick here is that both property funds and bonds enjoy an environment of decrease in interest rates. For property funds that are highly leveraged, their cost of borrowing comes down and the income available to shareholders goes up. For bonds, a drop in market rates has the inverse impact on the capital values of the bonds, which means the price of the bonds should increase and capital gains should be realized. Now, when will rates start dropping? Of course, we don't know for sure when the South African Reserve Bank will start cutting. At the time of recording, the narrative in the US is all about expectations for cuts this year, thanks to US inflation data that came in softer than expected. And it's even more likely that South Africa can cut, given where our economy is right now. Of course, this all begs the question of, is it really this easy to sell out of one ETF, buy into the others, and be sure that it's going to work out? And the answer is no, of course it's not that easy, right? No one has a crystal ball in the markets. For one thing, lower interest rates mean higher valuations for equities that have cash flows far into the future. This means that high growth companies in the technology sector should celebrate a decrease in rates. Technically, it is possible that the big tech names rally even further from here, although I would strongly caution that they earn a healthy portion of their cash flows from near-term profits, not just long-term hopes and prayers. They've also been running really hard because people have seen them as a place of safety and growth in this general market rally. If I wanted to play that theme, I would far rather rotate right now into an ETF that holds a lot of frothy technology exposure, risky, high-growth stocks, some of the smaller names in the tech sector. I could be totally wrong about this, of course, and I might watch that Infosys ETF rally now that I've sold out. It's possible, and that's the markets for you. It is impossible to capture 100% of a potential move, and if you're going to beat yourself up about this stuff, then you probably shouldn't be active in the markets because you'll drive yourself mad. I could also be getting it wrong on the local property and bond exposure as well, but in this case, I struggle to see how I get a bad outcome here. I might just get a slightly disappointing one. My TFSA is going to earn strong distributions from the property ETFs, and it's going to earn interest coupons from the bond ETFs. It's far more likely than not that rates will start dropping at some point, which should then boost the capital values of these investments. Yes, no portfolio strategy is without risk, we all know that. But this rotation feels sensible to me based on my own risk tolerance and what my portfolio looks like. And goodness knows it would be a lot less attractive if it was not for the tax-free nature of this rotation. It would hurt a lot to pay tax on those gains I made on that Infosys portfolio. And this is why I make sure I maximize my tax-free savings account every single year before I do anything else in the equity markets. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research and form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.